Hello, everybody. Happy Sunday. What a weekend it's been. We saw the Nashville conference for Bitcoin Friday and Saturday, and there was a lot of stuff packed in there. And it's triggered a lot of thoughts, including a lot of excitement too. But today, we're going to jump into the Q&A, and we're going to talk about a lot of very important issues that the community has. Hello, everybody. During the whole week. So let's dig in. Welcome to the Sunday walk in the Park of Alpha. Let's just call it that. We'll talk about Mt. Gox data. A little bit of a bombshell there. We'll talk about is the market going to crash? We'll talk about some price targets. We'll look at some new assets. We'll look at Bitcoin versus real estate. We'll look at allocations. We'll look at profit taking, price targets, if I didn't say that already, mutual funds, REITs, dividend stocks. You got a ton of questions and we got a ton of answers. So let's jump in. Thank you as well to Sean Donnelly and TD Tesla and Cade for being here. And of course, not financial advice. And all the questions come from everybody on Patreon. So, excuse me. Thank you so much. I have a little weird cough the last 2 days. First question. Let's not waste any more time because we're nearly 60 seconds in. This is from the Eternal One. James, do you know when the Mt. Gox funds will be released? I'm hoping to sell a bit in order to keep building my bags and buying the dip. Interesting. So I don't know. I know that over half has been distributed already, much to Kraken. I don't know where you're domiciled, but I can tell you a little bit of good news because a lot of people are concerned about what people are doing. So you said you might take some chips off the table. You might allocate to something else. But all I can say is I don't know where yours is. Some people are getting theirs through Bitstamp, others Kraken. And as far as I know, that covers most of it. But the good news for any Mt. Gox creditors is they had 10 years to sell their claims. Obviously, you didn't. So many believe there will not be many distressed or urgent sellers out there. I also covered this a week or two ago, the Reddit survey. I talked about how much would actually be dumped. And the answer is not very much. It is a Reddit survey after all. So how much can you trust it? But the calculation that I came with, maximum 25,390 Bitcoin would be sold out of over 100,000. So that's not too bad at all. And the on-chain data from CryptoQuant shows you that the money that went to Kraken was not sold. That was really, really good news. The trading volumes and exchange flows are normal. There was no instant dump, etc. There was also something that did change as well in our top and bottom indicator. And I think I've honed in on the actual change and why it went to orange all of a sudden, spiked. It's because when old long-term holders sell, that's one of the forms that directs the actual level of heat when a big chunk of coins move. And I think the movement from Mt. Gox to Kraken triggered a lot of that on-chain data as well. So we'll dig more into that next week. But right now, I don't know where your money is. I hope it's in transit. If you are in Kraken or Bitstamp, you should have it already. So please check that stuff. Next question. Thank you, the Eternal One. This is from Joshua. 1984. I have a superannuation fund in Australia. Last week, you talked about using some ways to protect your assets at the end of the bull run. We aren't allowed to use leverage in a super fund, but tax is also lower than personal tax at 15%. What is the best option to protect yourself in this case? Well, there is some good news for you. Let's break it down. I do want to stress, first of all, I am not Australian, nor am I in Australia, so I don't really know what's going on there. But if you say taxes are 15%, they are super low. And yes, you're correct. There is no leverage. Therefore, the only choice you have is to sell, which is actually not a bad choice too. And here is a quick glimpse of our new profit-taking model. It assumes just basic standard inputs. There's about 20 different things you can twiddle, from your cost basis to your level of aggression, etc. But per this will tell you kind of the layers at which you need to take profit, how much you need to sell, etc., based on your bag size or share size. You can put in 1 Bitcoin or 100 Bitcoin or whatever, and it'll tell you exactly where to allocate based on levels. So when we get closer to the time, I'll be sharing a lot more of this as well. It'll help you take some profits. But remember as well, especially after Friday and Saturday, I do just want to reiterate that, like, I consider myself pretty well read on all things Bitcoin, but I came away from those 2 days. I watched every single session. I took notes on every single session. I came away very bullish. Lots of good stuff coming. So hang on to your hats. There could be a possibility where we actually decide not to take profit if game theory kicks in, and we'll talk about that later as well. Thank you, Dr. Sauce, for coming. Next question. This is from Raul P. First post in Discourse. Hello, James. This is my first time posting a question for Q&A. Thank you for posting the MicroStrategy targets on the Bitcoin price. Can we do a similar thing for CleanSpark, if at all possible? Also, can you please share your ATR settings for CleanSpark? I tried finding them in your post, but could not nail them down. I shared them a couple of times in Patreon. I'll share them again later because ATR on deviation on the daily or the 12-hour is golden. That's basically all you need to do. The rest is standard. So check that out. But I will talk about price targets because they are a little bit tricky for this one. First of all, this is a list of all the analyst targets, and I averaged them all up, etc., over the next 12 months. So the average target is about $20.11. Coincidentally, I hedged at just about that price. Believe it or not, it's funny. The low estimate is about $5.30, and the high is about $28. The consensus is a strong buy. Some average targets from some other analysts that are more random, $24.38. I saw some at around $30, some around $12.50. It's all over the place, really. And you know what I think about analysts. There are very, very, very few good ones. Anyway, if you add all this together, you get a 2025 target of about $24.84. And 2028 target I found of $85.32. So take with that as you may. If you value CleanSpark based on how much cash flow, future cash flow they make, and if we assume Bitcoin's going between $80,000 and $100,000, that's a different kettle of fish altogether. Per this, you get to a target of fair value of about $55 if things continue the way they are. So you could say CleanSpark is 68.9% undervalued right now. So that is very positive. I know some people, when we were buying CleanSpark for $2, my bull target was $12. So we smashed that already. But since then, a lot has changed. They have one of the leanest, meanest miners out there. So therefore, they could do very well and be very profitable if they continue to manage costs, continue to deploy new rigs, and the Bitcoin price goes up. So watch this carefully. So we've got somewhere between 28 and, what did I say, $55. What's important, though, is layers and profit taking. And yet again, I'll show you the layers that I believe are possible based on our models and our profit taker. And the big takeaway here is, per the model, we are heading to $39 potentially. But on that route, it's also going to be important to take profits. And the reason is the buzzsaw. The buzzsaw is what I call the ATM. You know, miners are renowned for their stock issuance and dilution, and that can hurt prices. Apparently, CleanSpark has said they're done. They appear to be done from the models that I look at, but we shall see. But we don't know what's going to happen next. If another miner comes into the game and they start buying all new rigs and all of a sudden CleanSpark aren't competitive, they might have to go to the well once again, which could dilute. So therefore, be very, very careful with miners. I have a certain allocation, and you will know what it is for my maximum miner allocation. After that, I take stuff off the table. I do hope they pop, and I hope they hit that $30, $38, $52, $48, somewhere around that time frame. We should expect those targets to hit in the next 6 to 12 months, if Bitcoin does what it does, what we think it'll do. But remember, I do want to stress this too. MicroStrategy is very easy to arb and estimate. Very easy. MicroStrategies are miners are not. So I have one coffee today. I'm trying to ease up on the coffee, and that's taking its toll on my brain right now. I need caffeine to work effectively. Anyway, predicting the price of a miner is brutally difficult. We also have this new wild card called HPC, High Performance Compute, per the AI revolution, which is also throwing a bit of a wrinkle into the space. So be careful, everybody. If you have more than 5 or 10% allocated to miners, your portfolio, in my opinion, is very risky. So take that with whatever. Hope that helps. Freedom. 85% of my portfolio consists of real estate and only 4% is Bitcoin, excluding proxies. In the last 3 years, real estate returns pale in comparison with Bitcoin, and I'm considering to sell some and convert it. But the time I have cash on hand, 2 to 4 months, we might be 3/4 into the bull run. Thoughts? Would it make sense to DCS in during the bear? So much good stuff in there, and I'm glad you said all those things. As you know, I say we are more than halfway through the bull right now. 3 to 4 months. Real estate's not liquid. It takes time to sell, takes time to receive the cash, etc., and deploy. So yes, we could be getting very hot. But I put this chart together for you because I thought it's kind of super interesting, just for people to understand where home prices have gone in terms of Bitcoin. Back in 2011, the average, by the way, this is a chart of the average US home price sold in any given year. It is a beautiful chart, and I divided that chart, that line, by Bitcoin price, and the numbers are phenomenal. So back in 2011, an average US house would cost 77,500 Bitcoin. 2015, you notice I took these 4-year cycles for a reason. 2015, 1,500 Bitcoin per house. 2020, 60 Bitcoin per house. And today, exactly today, 7.14 Bitcoin per house. And then, and I posted this earlier in the community, everybody says, well, what's it going to be in 2028, 2030? And I said 2030, it could be maybe somewhere between a half of a Bitcoin and 1 Bitcoin per house. And then people are like, whoa. So you're dead right. You are way too heavy in real estate. As I said last year, if I could have snapped my fingers and sold my real estate, I would have done it. I can't. It's illiquid. It's hard to sell. It's also hard to sell an asset when interest rates are high. It means the prices are low. So you're stuck. So let's talk about a couple of things, though, because this is so interesting for everybody out there. And I used to always preach three-legged stool. Everybody needs a castle. First of all, that's correct. And I also used to say, have about 30% real estate. You're 85, 82, 80, whatever. You're way too high. But even at that, because my positions have exploded so much in this bull market, my real estate percentage now is actually really small, where it used to be a third. If you talked to me 3 years ago, it was like a third. Now it's like probably less than 10%, far less than 10%. Anyway, let's talk about a couple of things regarding real estate. This is from Michael Saylor's presentation, which was mind-blowing on Friday. I covered it in Friday's video, Nashville Day 1. And this was just so hard-hitting to me. If you buy a $10 million home in Miami, it'll cost you $600,000 per year in tax, insurance, utilities, maintenance, and upkeep. Okay? So that $10 million, you spend it all back in 17 years. So consider like a house. It does appreciate, but it's also a leaky sieve that costs a lot to maintain across all of those different factors. So that's the first thing. Second, regarding where you are way too heavy real estate. Bitcoin will always outperform real estate. DCA strategy can mitigate the risk of entering at a bull market, so I do recommend that. So DCAS is the way to go there. And real estate is not liquid. And timing the market is extremely difficult. This is the key part now for this. It's like anything else. Consider it a pair trade. As I say, everything is a pair. Your pair looks like this, but when you think about the pair, you got to think about the bear. Sorry, I didn't mean for that to rhyme. Sometimes just random stuff comes out of my head. But timing, the flip, is going to be key. And you're dead right, being by the time you get ready to pull the trigger, you might be buying or selling into a bear market or into a bull, buying into a bull, whatever. If you look at this chart here, I put little bear heads over the bear periods. That's when real estate actually does well. It almost corresponds with the blue. So those little blue tiny windows in this chart is when real estate outperforms Bitcoin. They are few and far between. Sometimes they're a little bit long. They were kind of long back in 2020. but that was an anomaly due to COVIDians, not because of the typical market cycle. So think very carefully. If you do plan to sell real estate, time the bear. You want maximum real estate price and you want a low Bitcoin price, and then do the rotation. And that will pay a huge dividend, as you can see from this very simple chart. It's that simple. Excuse the bear emojis. I thought it'd be fun. Next, and this is a very important question, and this is from Cat Eyes. I'm a single mom, now in my mid-50s, and I've worked for pennies as an adjunct liberal arts professor at major university for 25 years. I finally did the math and realized that at this rate, I may never be able to retire. Here's what I hold. 200,000 locked in a 403B, basically large cap mutual funds, 40K in a Roth IRA and a personal brokerage account, half Tesla, 35% S&P index, 10% Bitcoin ETF, 5% MicroStrategy, and then 22K in crypto, 60% Sol, 40% Bitcoin. I have about 15,000 cash to deploy right now, and I need to get more aggressive overall plan to set myself up for retirement. If this were your situation, what would you do? NFA, not financial advice. And I've been watching you since the very beginning, and I am eternally grateful for all you do. So let's break this down. Now, I normally didn't want to answer this question because I don't want to give financial advice, but you framed it so well. What would you do? This is what I would do. But let's break down the numbers of the situation that we are in right now. You have... The focus for me will be the US large cap stock mutual funds. We're going to analyze them a little bit. Also, remember that you are in maybe some risky positions. Bitcoin, Sol, Tesla. They are high risk, high volatility, but also very high alpha. So I'm going to talk about those too. First of all, I broke down your positions. I created a little pie chart. You're nearly 75% in large cap mutual funds. Let me explain why that's a bad thing. I don't mind your Roth IRA, maybe the S&P 500 index. It's kind of like a safe bag. It's okay to go. But maybe when S&P 500 gets really toppy after rate cuts, maybe rotate a bit. If things are at certain prices as well, you got that 15K cash, which represents 5.4%, and crypto 7.9%. It's always good. Right now, I'm about 13.5% cash myself. I am a heavy cash position, but I'm hoping for a August or September dipperoonie, or for something to happen. I'll always find an opportunity to find a great investment at a great price, because I'm looking about 10 different things at the same time, and I'm ready to pounce on those when the price is right. Let's talk about some hard numbers first, though. Large cap mutual fund return over the last 10 years is 12.54%. I always say, if you watch this channel, if you are not making 14%, you are not treading water. Okay, 14%. Find a way to make more than 14% per year, or else your nest egg is melting away, which is not good. Let's look at exactly large cap mutual funds. I pull the index again into TradingView and divided it by M2 money supply growth over the last 10 years. The return divided by M2 money supply is 48%, which sounds great, except the compound annual growth rate is only 4% each year. That sucks. Okay, you need to get 14. You're not going to make it with 4 when you debase for the currency. And why do I talk about debasement? Well, if you look at inflation alone, boom, that's since 2020. It's savage from Truflation. 25.27% is the inflation rate just since 2020. Hard to believe. And if you're buying certain things like apples, you know it's a lot more than that. Electricity, a lot more than that. Car insurance, a lot more than that. Pick anything. Medical costs, healthcare, home insurance, way more than 25%. So that's part of the problem that you're facing as well. So let's break this down. And these are some ideas as to what I do first. Okay, so this is definitely not financial advice. First of all, 5 years from now, the reason I mention that is you got to wait till you're 59 and a half years of age on the 403B, or you take a big tax hit. This advice is crucial. If you withdraw anything from the 403B before 59.5, you will incur a 10% early withdrawal penalty, and in addition, regular income taxes. And that's not good. So plan on cutting your burn, holding out till 59.5. Also, the good news is 5 years from now, we'll have two bull runs behind us. So you have the time window to be invested in heavy stuff and wait for that 59.5 year age. If I'm estimating correctly, 5 years, mid-50s, that's where I came up with that number. Also, your cryptocurrencies. What I do here is you got 15K cash. I think about 35% Bitcoin, 10 to 15% Solana, because that is the winning trade of this cycle. There's no ifs, ands, or buts about that. And 50% into disruption. AI is going to be huge. And then of your 75% in that 403B mutual fund stuff, keep half in there or switch it to an index fund, because the mutual funds just eat your fees and they rarely outperform. Large cap outperforms the S&P 500 slightly, but you probably get eaten back on fees. So if you want to keep something really safe, like your S&P 500 index, rotate into that at a large cap, because now small caps are rallying, and then put the other half in Bitcoin and MicroStrategy and a little bit of Tesla. Now, let me explain why these two. And this might sound hyperbull, hopium boy, etc., but we have 5 years. Okay, 5 years, so you don't have to worry about having to pull money out in a year or year and a half. We'll have 2 bull cycles behind us by then. And this is from Michael Saylor. $13 million is the base case for 2045, which is only 20 years from now. And there's going to be a lot of excitement between now and then. And that assumes a compound annual growth rate, or ARR, of 29%. His bear case is 21% and bull case 37%. But the stuff happening, which is so important, that we all got from the event. Now, every pension fund is allocating to Bitcoin, coming real fast. Every day there's a new one reported. In addition, we've got game theory in play. I have never, ever been so bullish in game theory as I have been right now, this instance. This just came out from Hong Kong. Hong Kong lawmaker Johnny Ng refers to Trump's speech at the Bitcoin conference, and he said, regarding Bitcoin becoming an official financial reserve for a country or region, I think this is worth considering. This is what I call the financial district of China, Hong Kong. Game theory is on. There's going to be countries scrambling right now. Let's just allocate 2%. What the hell? Let's print some money, stick 2% into Bitcoin, see what happens. This game theory has never looked so alive than now. Now, the other asset is Tesla. And yes, I am heavily exposed to Tesla, investing hard in it since 2017. But I did this post in Patreon over the weekend regarding FSD 12.5. A couple of things here. First of all, and these aren't just, hopium, Elon Musk fanboys or whatever. These are real top-notch analysts who are super conservative. Brad Ferguson, he said, it is done. It is done. Okay, you've got people like Jeff Lutz, saying this is meaningfully different. The level of performance, it just blew his mind. Benjamin Way, FSD 12.5 is a game changer. 100 times more than 12.3.6. Well done, Tesla. Holmars, last night, Tesla drove him for 45 minutes with 0 interventions. And he saw a bunch of stuff on the way too, including Cybertrucks. From McKay, Tesla FSD 12.5 update is the best product of experience I've ever had experienced. And it's now straight up personal robo-taxi. I literally cannot believe it exists. It feels straight out of the future, pure magic. And AI driver, the car stops at nighttime for a black cat at night. Little cat. Whoops. It sees it. And that is crazy. So this is we're on the cusp of some people say, I say multi-trillion, or Convest say multi-trillion. Some people are now calling it a deca-trillion opportunity. It's big. It's really big. And this is from Dalton Brewer. Tesla is hilariously undervalued. Tesla is finally about to solve FSD, and the stock is well below $300. People truly have no clue. FSD is another 12.5 is another huge step forward. Soon the fleet will awaken. 7 million vehicles becoming autonomous at the same time. I feel like I wrote this for Dalton because he speaks exactly my language. These are just external experts on Tesla, and that's why I'm very bullish. And I know a lot of people have Elon derangement syndrome, and I understand that. But I'm not here for any derangement syndromes. I'm here for alpha. That's why I believe this one is a game changer. And you have the time. I mean, if you got a time frame of 1 to 3 years, you're good. You got 5 years, 5.5 years. So you can take the volatility and survive. So I hope that helps. Go back to your drawing board, look at some of these assets, get out of things that get you 4% per year. That's not going to cut it. You need 14 plus. Look at people like Mr. Saylor. Base case is 29%. Base case. That's what you want. All right. Not 29. It's risky. It's volatile. Bear market will make you want to pull your hair out, but it's worth it. And then when you're on the cusp of something like this, a $600 billion company about to unlock many trillions, that's your answer. Hope that helps. And thank you for being part of the family. Let's go. This is the first time Clearwell T has posted. What do you think of the chance of Tesla or MicroStrategy ever paying dividends? Well, I have a very strong opinion regarding dividends. Let me explain. First of all, why you never want to own a dividend-paying company. First of all, there is limited growth potential. Dividend-paying companies prioritize returning cash to shareholders over reinvesting in their own business, which limits potential for growth. I like growth. I like disruption. That's where the return is. They are also very conservative. They follow very conservative business strategies, like let's just milk this puppy as long as we can. Low risk investment rather than pursuing innovation or research and development. They don't pay anything into R&D. They just want to steady Eddie as she goes. They hoard cash. Look at Warren Buffett nearly has $200 billion in cash sitting there melting away. Again, yeah, he'll say he gets 4% in his cash. As I told you, the hurdle rate's 14. A lot of fours today. 48, 4, 14 just popped into my head. 14. Remember that number. Right on your mirror. If you're not getting 14% a year, you are drowning. And then market perception too. It's like, who wants a stodgy company? Investors perceive dividend-paying companies as mature and past their prime growth phase. But there's more. Don't just believe me. Let's look at some data to prove my point. This is from Morningstar. Data proves dividend payers underperform. Morningstar High Dividend Yield Index, which focuses on the higher yielding half of U.S. dividend paying market, only gained 3.9% in 2023, significantly underperforming the broader market, S&P 500, etc. Morningstar Dividend Leaders Index, the 100 highest yielding stocks that pay consistent dividend, only gained 0.9% in 2023, drastically underperforming the overall market. And yeah, people think, oh, but I get a 2% dividend or a 3% dividend or whatever. When you look at the net return, it sucks. And then you got to pay tax on those dividends too, which sucks too. You want to build your assets. So watch for all the leaky holes. And then another one here. This is REITs, another big dividend payer. REITs have suffered a total return loss of minus 20.18%, while utilities have lost minus 7.71% and minus 7.03% total over the same period. Again, anything that pays dividend is stodgy and slow growing. Be careful. So avoid that like the plague. The minute Tesla starts paying dividends will be the minute I sell my Tesla stock, because that means their growth is done. Same thing with MicroStrategy. Okay. If they had the cash to pay dividends, do you think Michael Saylor for 1 second would give it back to you? No, he'd go out and buy Bitcoin straight away. Okay, so you don't want that to happen. Dividends, bad. Not financial advice. I know people live off them, but that's okay, but not my cup of tea. Neo21, hi James, what model would be better for trying to build a sol bag by trading long and short sol, perps, ATR, or PTOS? Thank you. Interesting question. So what I did was calculate all the numbers, dialed in the models. Let's look at two different things. And they are very, very different. So first of all, ATR. If you had used ATR, and this is on the 12-hour chart, remember ATR is optimized for the 12-hour and 24-hour, which is the daily. You would have done 43 trades. Your ROI would be 247% with a 90.48% win rate. Not bad. But remember, that shows you where you buy and sell. The beauty of PTOS is you play up and you go short down. And you do that using inverse correlated assets. So a quick reminder here, these are some of the settings for PTOS Sol 3x long and short. That means you're going 3x leverage up for the long side and 3x leverage short on the downside. And they have these in different things like KuCoin, etc. Some of the settings, you can play it with a look back period of 60. Very important, not 30. Go for 60 on this one. You can trade on the 2-hour, 4-hour, 8-hour, or 1 hour, and the win rate is 100%, 100%, 100%, or 95% on KuCoin. But what I do is I play this one. This is Gate.io, and I use this to perp trade in Jupiter. So I use the information from Gate.io, quotes 3x long, 3x short, and I replicate it in Jupiter by going long and short too. So here on this, you have an 88% win rate. The win rate is lower. You would do, since the beginning of the year, 34 trades. That means 17 up, 17 long, 17 short. Use the 4-hour chart. Again, that's 60 period look back period. And just to explain what that means, 60 look back means you're looking back at 60 times 4 hours. And if you're in the stock market, it's very, very important because you've got less window of time to trade, so it's a much longer look-back period. So if you're trading stocks, you might turn a look-back period to like 20 or 30 instead of 60. So I hope everybody gets that. 4-hour chart, Gate.io, and you get a much higher ROI. So the answer to your question is PTOS is the moneymaker. And remember, dial in your standard deviations. Wait. Use the optimized trend. Wait for that puppy to turn before you go the other direction. Okay, and also don't be caught out too. We're in a very, we're getting into the banana zone. So everybody watch the optimized trend like a hawk. Absolutely critical. That will keep you in the trade. That will keep you long so you don't get off the train during the banana zone. Most important thing I said all day. Next question is from Keep the Dog. Hey, James, seasonality seems like it can be very useful, powerful tool, whether it pertains to macro or a particular equity. Larry Williams seems to be big on this, leaning more towards a specific equity. Do you use a particular indicator, or what would be a good source to find this information? So I do look at seasonality, but not that hard. And let me explain why. And Larry Williams, friend of the channel, he was on the channel too for 2 videos, not 1. But the reason why seasonality works sometimes is there are predictable patterns. Certain sectors do certain things during certain seasonal times. For example, retail stocks do well during Christmas. All that simple type of stuff. Then you have economic cycles, economic activity such as agricultural planting, harvesting, increased energy consumption during winter can create very predictable seasonal events in stocks, utilities, etc. Also, investor behavior, things like the January effect, where small cap stocks tend to outperform in January, are driven by investor behavior and portfolio rebalancing at the start of the year. As I say, smaller horses run faster. Normally, a good small cap stock can do better than a big one, but not in all cases. That was quite different so far this year. And institutional actions, large institutional investors sometimes follow seasonal strategies such as portfolio rebalancing at the end of the fiscal year. I call it window dressing. Many other people do too. So that's where it can work. But why I don't like it is as follows. This is why I believe it's very unreliable, especially for disruption and innovation stocks. Disruptive stocks, often technology, biotech, are driven by innovations and breakthroughs that do not follow predictable seasonal patterns. We just talked about one as well. FSD being solved by the end of the year. That has nothing to do with seasonality. That is a breakthrough. So bear those things in mind. Then what else do we got here? Market sentiment. Disruptive stocks are highly sensitive to sentiment out there and what's going on with the technology. Macro factors, geopolitical tensions, wars, interest rates, economic crises, recessions, you name it, money printing, etc., all have a huge impact. Also, low correlation assets. Check out seasonality. You can see them in charts. And also, there's data limitations. You don't have history of disruption companies and AI to look back and how they perform with different seasons. And then you get outliers, stuff like C19 hitting, which can mess up stuff. And now, because there's more information, this is one of the things I was talking about, front running, because there's more information out there than ever before. If everybody expects, say, the market to rise or say tank in January, they'll start selling in December, for example, if there's a certain amount of seasonality in place. So from that perspective, I don't agree. The things that really do matter, though, way more than seasonality, is the liquidity cycle, money printing, interest rates, valuations, and disruption. Focus on those things. Way more important than seasonality. Unless, of course, you're just trading retail stocks, which we don't do here. So thanks for the question. And next question is, Michael A., I'm new to Patreon. Grateful for all you do. Are there any other companies that could benefit from the rise of Tesla? Companies that supply parts, cybersecurity companies, companies that will benefit from robotaxis? I get this question all the time. And it's always about, I missed company X, like NVIDIA. Who is the next NVIDIA? And sometimes there isn't. So that's important to know. And also, always buy the winners, not the service providers. And the reason for that is vendors and service providers operate in very low margin businesses. It's very competitive. They don't have any unique special sauce. Like if you're a battery vendor to Tesla, you're one of many. And this limits their ability to achieve high profit margins. And believe me, cleaning robotaxis, that will not be a high profit margin business. Then you got leaders like NVIDIA and Tesla. They operate with very high profit margins. Not now for Tesla, but when robotaxis come, they will be. But you see that in their megapack business. But that gives them a huge advantage. It gives them a very strong market position. And again, don't try look at the ecosystem. All the money is made by the motherships, as I call them too. And I decided to throw in a little bit of a corollary to crypto as well. I thought this is interesting. This is a layer one, Solana, versus a service provider, a Oracle called Chainlink. And since 2023, Solana has done 700% better than Chainlink. And Chainlink has had a great run over the last year and a half. But Solana has smashed it. So again, it reminds me of the 90s. Everybody got very excited by DSL providers. There were so many of them, so many DSL startups on the infrastructure side. Again, service providers, all of them went to zero. So that's how it works. Next question is from Jesse H. Your content has been so helpful to me. I wouldn't have been in Solana and MicroStrategy if not for your great educational info. I was interested in a small public company that has added Bitcoin and Solana to its treasury. And it's also a crypto asset manager. The company is DeFi Technologies. Seems to be a good Sol proxy and did very well in the last bull run. What do you think of it? Well, there's a couple of red flags out there. They have less than a year of cash flow. They're losing money. But let's look at some of the things I would look at if I'm looking at a stock and things. Again, everybody out there, you have access to brilliant, safe, high reward, low risk stocks. Don't gamble on flyers. Don't gamble on service providers. Don't gamble on things like this. Let me explain why. First of all, the ownership breakdown. I've never seen this before. Okay, pretty much institutions have 0.0317%. There's no institutions in here at all. It's all individual investors, 7%, and general public, 92%. Very bizarre. Always a red flag. When institutions aren't in your name, not necessarily good. Also, this is a nightmare. This is their earnings, and I know they're an asset manager, but this is not good, and they're almost out of cash. If this continues, they will be bankrupt unless they issue a bunch of shares, which cause dilution, which puts pressure down. Now, back to your question, is it a Sol proxy? For example, I analyzed how much Sol they have on their balance sheet, 12,000 Sol. Considering you could have bought it at $8, that's not a very, very big position. They are 0.005 as a ratio of Sol to their market cap, which is nothing. The market cap is $456 million. So, not good. And finally, hard pass. Skip it. And the best part of the show, helping analysts, is Apia. Apia is a plucky young girl, female elephant, who survived some remarkable bravery, and she's in the Sheldrick Wildlife Trust to help her with care, food, shelter, medical, and she doesn't have a mama anymore, but she's a very tough and feisty little girl, so thank you all for making that possible. Tomorrow is DCA Live, 7:40 a.m. Pacific, 10:40 a.m. Eastern, and 4:40 p.m. Central European Time. And I hope you like the show. We'll do some live Q&A right now. That was a big one, 56 slides. Thank you all for coming. 4,000 people watching live. Love it. And that's good for a Sunday. Let's go to some questions. Justice for all. Have you looked into running a Sol validator? Process, cost, benefit? If not, curious for your thoughts and knowledge regarding. I would never run a validator because I've seen what happens with people, and I have 100 opportunities. People say, can you run this? Can you run this? Can you do this? Can we partner on this? I don't ever want anything to skew my view of an asset. Imagine if you build up a whole bunch of Sol infrastructure, and then you get people to stake with you. You're beholden to them. You see that happening with Cardano stake poolers. They start preaching that Cardano is going to $10, and all of their listeners listen, and they hope, and they just leave 1,500% gains on the table over the last year by not being in the right asset. I never want to get married to an asset, and I'd never want to push anything on anybody like a validator or staking or anything else. So now, there is one little caveat to that, Team Metallica, and that is with FireDancer, people will be able to run a Sol validator on very basic hardware. So that will open up the decentralization, and anybody can spin one up if they want to. So that will be good for the space. But no, I would never do that. Sol Strider, I'm obsessed with ATR. Thank you for the tools you provide. Good, enjoy it. Keep dialing it in. Remember, play the different models, deviation and trend, different assets, different times. Check the back test. But it is, it's money. From Hobbit, PTOS or ATR, if you had to pick one. If I had to sit at home all day and just trade and try build a bag fast, I'd be in PTOS. If I was somebody that would do 2 trades a week, I'd do ATR. That's the easy way to think. If you're a very active, aggressive trader, and you like to play up and down, and you're watching the market all the time, PTOS is the one for you. And of course, you got to be swift and good. And ATR is, again, identify when to sell calls or sell puts. Sell puts at bottom, sell calls at top, and build your bag that way too. But you don't have the stress of having to watch the movements all the time. And that's what ATR is built for. Piper, thank you as well up there in Canada. Thank you for your super sticker. Long-term holder, Dr. Sauce, Rhonda Zhang, Signal 103, Forest M, CERN Dragon, Sparky 444, Sneaks 123, and where can I get PTOS? Go to InvestAnswers.io. You'll see everything there. And as well, The Great Escape. Thank you all for coming. That was a big one today. I'll see you all bright and early tomorrow morning for DCA with the guys. It's going to be good. Good night, everybody. Thank you as well to the mods in the chat for keeping us all safe. Bye-bye.